Hi, my name is Jordan Wilson. Today we're going to talk a little bit about investment professionals. When we looked at mutual funds, we saw that manager fees make up the bulk of the management expense ratio, the cost of owning a fund, that the asset managers or the investment advisors basically control what's in your investment portfolio. And we talked a bit about potential shenanigans, and hopefully those don't exist. But let's talk just a bit today about those investment professionals. So our objectives today are just look at a few different types of investment professionals. What sort of advantages do they bring to the table for you to use, for you to incur a management fee for their services? And what are some of the potential disadvantages in working with a professional? So the professional types are going to be, let's say, asset managers. That'll be the person that makes the buy, the sell, maintains your portfolio in a mutual fund. It could also be a manager that runs a discretionary portfolio. Maybe you have an account with your bank and your money is invested in a discretionary account in which an asset manager makes the purchase and sale decisions. Another type of professional could be a research analyst. Those are the folks that make the buy and sell recommendations. They analyze companies, usually in a specific market segment that they are skilled in, and they say, this is the one you should buy, this is the one you should sell, or you should hold. And a lot of those times you'll see the research analysis recommendations in the Yahoo Finance under a specific stock. So if you have 30 analysts following a company, you'll see their average rating, you'll see the distribution, who's recommending a company, who's not. And that helps investors decide, hey, if this expert likes this company, that should be good enough for me. It's also the same if you're dealing with a brokerage house, you get a phone call, this is on our buy list, you should buy. That recommendation is coming via a research analyst. And then let's call investment advisors, investment professionals, not quite the same as that we're going to talk about mostly here. It'll be mostly the asset managers with a little bit on the research analysts. But investment advisors can also persuade or dictate what you invest in. That could be a fund salesperson providing free advice in exchange for a commission by selling a mutual fund product or the ongoing retrocession fees that they receive from their clientele owning a specific fund. Or it could be just the bank employee that you're dealing with for your RRSP or your year-end IRA, who usually is recommending an in-house product. So free advice. You might see advisors who charge percent assets under management. If you have an account and your bankable assets are $2 million, maybe you pay an annual fee of 1%, which gives you free activities, a free visa, a free checking account, discounts on wire transfers. And usually there's a advantage in using them for your investing because you're not paying a fee for buying or selling the investments. That's coming out of the assets under management percentage. You also have people, in this case like myself, that are fee-only fiduciary advisors. More like a lawyer, accountant, doctor, or you come to a fee-only person, pay a flat fee or an hourly fee, depending on the situation, and you get objective, unbiased advice. These people tend not to be working for a bank, for example. So if you go into a bank, magically their funds tend to be the best. Here it's just, okay, here's what we think globally is best of breed and it meets your investor profile. That's what we would recommend. So that's kind of the three different types of investment advisors that you'll see out there. Occasionally there's hybrids of the three. Advantages of using an investment professional to run your portfolio? Well, I mean, the first one obviously is technical skills. Asset managers and researchers have strong skill levels. I mean, there's no doubt about that. Some advisors may, others do not. You sort of have to look at what does a specific financial advisor bring to the table. And there's a myriad of different types at the lower level. Some are better maybe in insurance, some are better in financial planning, some may be better in investing. But on a technical side for investing, you probably want to see someone with a chartered financial analyst designation. An MBA is common as well. And often a lot of these people will have certificates in investment performance management. So sort of that advanced investing designations. They also tend to have experience. Many years in finance and investing. You're not going to see someone running a large mutual fund that just stepped out of MBA school or just received their CFA designation. So you're getting technical skills and experience. Another underrated aspect is that the pros have access to better tools and data. And that's important, I think, because a lot of us can invest, but we need more information to make better investments. And the more information and the better quality of information and the more timely the information, the better decision making. The other thing when I talk data is the access to the corporations they follow. So a research analyst may be sitting in on the company's quarterly calls. He or she may have better access to key players in the company. Now, I'm not saying that they get inside information, but they probably get better information than you or I that have to read about it in Yahoo Finance or the local newspaper. So that's an important. Also, what you see is, especially more and more today with activist investors, is that people that have large holdings in an asset, say an equity stock, they're putting more and more pressure on the companies that they own in, shares in, to follow certain agendas. Maybe that's environmental or social or governance. Or you can use an example like Warren Buffett. I think he's off the board now, but he was on the board of directors of Coca-Cola because he held, through Berkshire Hathaway, a huge position in Coca-Cola. So if Warren's sitting in on the board meetings pushing the direction of Coca-Cola, that's an advantage. And not necessarily for the investment itself, but just you're inside, you are the one that's helping drive the bus. And the last big advantage is it's their job. Now, I don't think investing is overly difficult. But then again, I have some, let's say, expertise in investing. That's my job. I've done it many years. I'm a chartered financial analyst, so I've got the technical capabilities, supposedly. But I think that a lot of you can become good investors on your own. And part of it's, learning from this series, developing better education and awareness. But the problem is for many of you is that you're lawyers, your doctors, your dentists, your nurses, your plumbers, your government employees, all that sort of stuff. You're working in your own field an 8, 9, 10-hour day. Do you have the time to compete against somebody that's actually spending those 8, 9, 10 hours a day on investing? So you're at a bit of a competitive disadvantage, regardless of how much commitment you have. It's just a sheer numbers game. They can do this 7 days a week, 11 hours a day. Do you have that capacity? So that's another big advantage. So you have someone that's technically advanced, experienced, has the tools, the information, and that's what they're doing 5 days a week, 11 hours a day. And intuitively as well, you'd think, okay, these are pros. I'm not going to go on the golf course, challenge Tiger Woods, or on the basketball court, LeBron James. Hockey, Connor McDavid. Heck, we're not even going to challenge people in Div 3 at university because they are so much better than us. So why would we try to compete against investment professionals when we can outsource? I can say, hey, Tiger, I've got a golf match at my local club this weekend. Can you step in for me and see if you can win that match? Probably shock the heck out of my opponent if Tiger Woods stepped up in my place. Conversely, Tiger's not going to ask me to step into the Masters tournament on his behalf. So that's the advantages of outsourcing your investment management to a professional. Disadvantages? Well, it's true in all professions, but you obviously have better and worse professionals. The key is to find the better and not the worst. It's also true that the better professionals over time are able to charge a premium. And you see that again in all areas of expertise. You don't see Tom Brady making as much as the third string quarterback for the Tampa Bay Buccaneers. It's just the better people are able to charge more. So if you want top end, you're going to have to pay for it. The other thing, especially with analysts, which is interesting, is that better and worse can change quite quickly. And it's interesting if you actually look every year, certain organizations give out awards to the best analysts in the various market segments. And it's funny how little you see repeat winners. It's almost a bit like the Academy Awards for Best Actor or Actress. You don't see Meryl Streep winning 9 out of 10 years like a Tom Brady or a LeBron James or a Tiger Woods is best in their field. There's a lot of fluctuation from year to year, and that kind of goes back to my earlier comments in prior sessions on luck being a factor, good and bad, and that it's hard to actually pick the winners and losers. So you do see a lot of fluctuation as to, especially on the analyst side, who is the best. Another, not saying it's a huge disadvantage, but neglected markets. A lot of professionals may not cover or invest in certain market segments. So maybe I like to use the Canadian Junior Mining Company segment. You're not going to get a whole lot of Wall Street experts focusing on mom and pop mining companies in Saskatchewan. Their focus tends to be the larger cap because they can't practically invest in those companies. They're too small. So things like micro or nano cap stocks may be neglected. There may be a lack of information. East African equities may be tough to analyze. So you may not get great exposure if you follow the experts in certain neglected markets. Now that's becoming less of an issue with each passing year. It used to be if you follow the exploits of Sir Templeton of Franklin Templeton Funds or Mark Mobius, who was his go-to guy. It's almost like a Raiders of the Lost Ark, where the guy is traveling all over the world in the depths of the forest to find, in this case, investing opportunities. Much less, we talked before, there's now 3 million plus indices around the world, so it's less of an issue for neglected markets. The other issue with neglected markets or niche areas is if there's less competition, that means higher fees. If I'm buying an S&P 500 index fund, there might be 1,000 out there for me to choose from, so that drives the cost to the investor down. But if I'm looking at mom and pop mining companies in Alberta, maybe I only have 2 or 3 options. So there's less competition, they can demand higher fees. I will also say that neglected markets do provide an opportunity for amateurs, you and me, who have specialized skills. And by that I mean, maybe I'm a geologist, maybe I'm a petroleum engineer, those sort of things. And in that case, if I live in Saskatchewan, maybe I have not inside information, but an inside edge into identifying the areas of the province where there are good plays or companies that are doing successful that aren't followed by the Wall Street or even the Bay Street analysts. So if you're in a niche area, fine art, maybe some real estate in certain sectors, you can have a competitive advantage. A buddy of mine does real estate, commercial real estate in Poland. Again, that's some area that doesn't have a whole lot of competition, so he does quite well. Another disadvantage, and this one's significant, is management fees. As I said above, the better performers command the higher fees. You also see, especially in neglected or smaller markets, or complex active strategies they employ, the more work that's required, the higher the fees and costs. And as we saw in our compound return discussion, fees and fund expenses or other expenses are going to dramatically hurt your compound returns. We saw that again with our RBC example from a few sessions back. The market was doing 5.95% on average over the last 10 years. The RBC fund was only doing 3.6%, in large part because they were charging a 1.89 management expense ratio to the lower end investors. So that's eroding a significant portion of your return that can't compound on your behalf. And I'm not sure yet we'll call it a disadvantage, but let's call it a question mark, is I'm paying for this expertise a pretty penny. Does it actually outperform? And that's where we get into the active versus passive management debate. Do active managers provide alpha? And alpha is outperformance versus the benchmark on a net basis. So in the case of the TSX Composite over 10 years doing 5.95%, can an active investment professional, after we pay his or her costs and trading costs and all that sort of stuff, can they produce 5.96%? The answer may be yes, maybe no, but that's the active versus passive managed debate, and something we'll get into starting next session. That's all for today. Just a quick outline of the pros and cons of using an investment professional to manage your money. And now we'll look at the meat and potatoes of the issue. If I'm spending money on an investment professional, do I get value? Thanks for listening today. We'll talk to you next time.